Good afternoon. My name is Cherie Andre, and I am the Client Relations Manager at Prestige Wealth Management Group. And I would like to welcome everyone to our Economic Update webcast. I will be the moderator for today's event, and as always, our goal is to continuously add value for our clients by helping to educate you and keeping you informed. Today's discussion will be hosted by Roy Williams, CEO of Prestige Wealth Management Group, John D'Angelo, Managing Director of Prestige Wealth Management Group, and Paul Esposito, who serves as our Senior Portfolio Manager. This conference call will be in a listen-only mode and should last approximately 30 minutes. No participation is required, and there's nothing you need to do except sit back and relax. We will take care of the rest. We can't take any live questions during this call, but we do welcome your comments and suggestions. So at the conclusion of the conference call, please feel free to send us an email with your comments and or questions to pwm@prestigewmg.com. And with that, here's Roy.
Welcome, everybody. First let's go through the agenda. The first thing we're gonna look at the third quarter recap, and then we're going to look at the global economic and capital markets outlook, and we're going to talk about the China trade and Brexit, which is on everybody's minds. So, in recapping the third quarter, really there hasn't been a change from the last quarter, second quarter, Paul, in a lot of areas, right?
Yeah, so especially when, we reassess, I guess there's been a lot of concerns over, us entering in the fourth quarter of this year. So if we look at, maybe I'm dialing back, to last year, Q3, Q4 environment of 2018, we were obviously in the heat of a trade war. We started to see some deterioration in economic data, albeit most of that data was good. But one of the biggest differentiators was the fact that we had an unaccommodative Fed. So this year, obviously, equity markets have done rather well. Most asset classes have done rather well. And, the narrative as last year is the same, right? Trade war, although it looks like with this recent phase one, we're looking, to be a little bit more constructive there. But the difference between last year and this year is that we have an accommodative Fed.
But I think especially from the last quarter's call to today, we were waiting to see what the Fed was going to do, and they were expected to cut rates for the first time at the end of July, which is about a week after our call. The Fed has kind of moved from neutral to accommodative since the last time we spoke.
Yeah, and when we look at a lot of the mixed economic indicators, retail sales came out today and was a little soft, and and we'll talk about some of the indicators. A lot is cause and effect, meaning the China trade situation and the tariffs are causing effects that are negative to U.S. earnings. Most people don't realize a company like J&J or Colgate, they have well more than 50% of their revenues coming from overseas. So a stronger dollar hurts their earnings because now when they bring those currencies back to the U.S., that makes it more challenging.
Right. Well, yeah, and if you look at just the trend in earnings, we've actually seen a decline in earnings for the first two quarters of this year. It was expected that the Q3 earnings for this year were also going to show a slight contraction. A lot of that is attributed to Forex. A lot of that is also attributed to uncertainty and capital spending of companies. It'd be interesting to see how the rest of this earnings season pans out. So far, banks have already provided, what I view to be pretty solid earnings. Certain parts of healthcare have already started to, and we'll get into the brunt of earnings to make a better assessment for what the rest of the year and what guidance will look like for 2020.
So far, earnings have been good, but it's just a very narrow number of companies reporting. Looking at some of the economic numbers. First off, the manufacturing purchase index. You have to understand manufacturing and service make up our economy. Manufacturing and the world's economies. Manufacturing, John, it's been pretty soft.
Yeah, and it's a direct direct cause and effect from the uncertainty around trade has, from a manufacturing perspective, caused what you would call global weakness across the board. And that's certainly, what I would say very adamantly depicted in this chart that we have up.
Yeah, and again, really a quarter after we have a trade deal, Paul, I think that will really tell us where the economy's heading at that point, right?
No, I agree. I mean, again, look at just the trend in the data from last year. I mean, you had broadly most of the manufacturing data for the developed world was in expansionary levels, and that was when we really started to lock horns with China and other countries with trade. And that uncertainty, ultimately manifests to broader weakness. Now, Europe, of course, has some other issues that I think exacerbated some of their manufacturing weakness. But broadly, you could see the feedback loop, the negative feedback loop that we've had. And, the fourth quarter of last year, with just this being at least positive, you would have expected that there wouldn't have been as much volatility, but markets discounted, obviously, softening of that data, which persisted. But if we actually look at service-based numbers, and that's an area of concern that I think we have had just for the most part of this year. So manufacturing numbers in blue, this is dated as of 8/31. As of the end of September, that manufacturing number is actually deeper into the contractionary territory of about 47.8. Usually the non-manufacturing number, and this is a number we're probably most concerned about because the U.S. and most developed market countries are service-based economies, right? 70% of our GDP potential comes from non-manufacturing based consumption and services. So it'd be very interesting, for us to see, if in fact this tends to drag down the non-manufacturing number. They tend to work in lockstep with one another. We saw a similar pattern here in the manufacturing recession of 2015, 2016.
It wasn't a recession.
It was a manufacturing
recession. It wasn't an economic recession.
It wasn't an economic recession. Thank you for highlighting that, Roy. But again, very similar. We're starting to see that track. We're still, for the service-based numbers, still at 52 and change, so we're still in expansionary territory for the end of September, with a lot of the constructive negotiations that are going on presently. Who knows? Maybe we'll actually finally start to see a bottom in the manufacturing number, and we'll start to see upticks.
And from working with a lot of corporate executives, a lot of companies are waiting for the trade deal, and putting their strategic plans in place. Right now, a lot of companies are being defensive. But one other thing before we go into China about trade, this past quarter we came in agreement with Japan in a trade deal, which Japan's the third largest economy in the world, not far behind China. So that's a big deal too, which hasn't gotten any press. I mean, that's a very, very positive piece. So, in talking about China, believe it or not, China is getting hurt economically more than we are at the current point. John, we talk about this all the time, that it's a bigger impact on them than us.
Right. I mean, as far as we are concerned, we're more of a net consumer than an exporter to China. I'd say probably the administration is most concerned with agriculture as it relates to trade, because we are a big, or I should say China is a big trade partner with us and our farmers. So you see that in the news all the time. So that's in relation to this phase one part of the trade deal that the administration came out with this past week.
Yeah, I think, in looking at, the constructs of at least the initial phase one agreement, it certainly is the olive branch that I think the markets were looking for, right? So it looks like agricultural products will be put back on. for export into China. One of the, I guess, the biggest parts, and it's really is probably going to be tackled in phase 2 or phase 3, is the intellectual property concern. So they really haven't hammered out, a particular assessment of
Right, and
that.
China came out in the news, on Friday or Monday, that they want more talks before signing the deal. So it certainly put a lid on market upside on Friday. But you can see that just from the strength of the market move early in the day, that from an asset perspective or asset price perspective, that the market would probably jump out of this long-term trading range that we've been in if we get some clarity around China trade.
Right, and if you actually look at, just in terms of trade, John, you alluded to this before, percentage of GDP that China's exporting to the U.S., relative to its overall share of exports, it's noticeable, but it's not as much as what China is trading with the rest of its trade partners. I think one of the biggest unquantifiable aspects of the trade deal is the intellectual property concerns, because, we know that China is, predominantly a manufacturing country that's trying to shift into a consumption-based economy, but that's where the question lies. Stealing intellectual property, does cost the U.S. to the tune of hundreds of billions of dollars a year, and that's a rough estimate. If you look at the GDP of U.S., it's about 22 trillion. You look at the GDP of China, it's number 2, it's at 16. And given the fact that they're trying to form into their own consumption-based economy, the intellectual property infringement would actually be a huge detractor to their economy if they had to, play like the rest of the world does, or the rest of the developed market world. So you could clearly see how much that could actually impact their future GDP potential in the future.
Yeah, as with our call with Jeremy Siegel from Wharton, famous economist, he said, his view was any trade deal will benefit the markets and the economy just by removing that uncertainty, and we can work through other parts of the trade deal later on. So having something is better than having nothing, in terms of having our economy move forward and having corporations spend money, having consumers, again, not concerned, and, again, spending money, and that has a huge economic impact.
Yeah, I think from a standpoint of U.S. corporations, just knowing what the rules of play are, the rules of engagement, what are my actual costs of doing business, is huge, when you think of forward earnings potential.
Yep.
Yeah, this is really just to support the fact that, really both sides have been battered. As evidenced by the manufacturing chart, PMI chart that we showed earlier, this solidifies that China is, in fact, being backed into a corner. If you look at their exports and imports, really since trade rhetoric crescendoed here, at the start of 2018, it's been a slow and steady decline. Now, trade balance has still been positive for them because they're still sustainable net exporters. They've also, devalued their currency a bit too, which has helped with that. But I think what this chart really helps characterize is that both sides, I think, understand the need to at least come to terms with some formal agreement, because it's hurting both economies. It's hurting the U.S. And in particular now it's really starting to impact China and China's growth potential.
Yeah, and China, being the type of economy they are, most people don't realize they devalue the currency to offset the impact of tariffs. So by having their currency stabilize and other Asian currencies, again, that will help earnings of U.S. corporations. Unemployment, it's an interesting piece as we look at, even in the future when we have a recession, my view, it's going to be a little different. And I'll have Paul speak to the points of the slide. But the reason why it's going to be different, you have 10,000 people a day turning, 55 to 65, and some of those people may have the ability to choose to retire rather than really be active in the workplace. And if they're given packages to retire, they may take those packages and have enough assets to retire. So just because of demographics, that helped us recover from very, very significant unemployment rates, again, by the aging of the population. But, Paul, why don't you speak to the points of the slide regarding wage growth and unemployment?
I think this is really, it speaks to the dichotomy of a lot of the economic data that we're seeing, right? So there has been some softness in some of the broader data, the manufacturing data, some weakness in the non-manufacturing data. Consumer sentiment has actually been, fairly positive. We did see that come down in September. However, it's very difficult for us at this point to really entertain the fact that there's going to be an imminent downturn within the very immediate future, given the fact that we have unemployment, which I know these are August numbers. The September numbers are down to 3.5% for unemployment, and you have very, very strong wage growth. So this speaks to at least the capacity or strength of the consumer here in the U.S., keeping the economy at least stable or in a low growth environment. There also has been a lot of concern, and I know we talked about this, Roy, in prior webcasts about recessionary indicators, right? The inversion of the yield curve. Well, we've actually gotten a lot of concerns about, well, if unemployment's at an all-time low and wage growth is as good as it's getting, is that going to portend to some sort of downturn in the future? And our answer to that is, first of all, unemployment's a lagging indicator, which I think is better characterized if we were to actually talk about employment as a leading indicator. It's really not layoffs. It's really going to be hirings that are really going to preempt a downturn. So if you look at the trend in hirings here in the prior cycle versus the trend of unemployment, you can see that net hirings really started to flatline and decline prior to this gray area of the recession, whereas the actual layoffs ensued as you're in the middle of the last recession. As of now, we're still seeing a nice steady uptrend in hirings. Think about this. What do companies do when they see uncertainty, when they see weakness in the economy? They're going to take job postings down. They're not going to just start massive layoffs. That's the order of operation. So at this point, this at least gives us some credence that, at least from a corporate perspective, and this is a data point that we watch very diligently, that at least for the time being, we're not seeing that indication at this juncture.
Yeah, and again, that's a big indication because normally, as we have a recession, unemployment spikes and people reduce spending. But looking at global monetary policy, John, as a team, we speak about this all the time, and we spoke about it earlier. The Fed has been accommodating, but not just the Fed. Who else has been around the world?
Sure. Global monetary policy has been in an accommodative state now for a while, and a lot of it has to do with this manufacturing slowdown, which is global. So you're seeing, Europe cut rates, Germany, because they're trying to spark their economies, and now the United States has done the same, starting in July. And, even the last time, Chairman Powell spoke, he kind of stopped talking about, a mid-cycle adjustment. So it seems that they're leaning toward continuing to accommodate the economy, and kind of re-spark growth from the levels that we're at today.
Yeah, and again, as we go forward, you know, it'll be interesting to see what happens, how the economy bounces a quarter after the trade deal is signed with China, because I think that will also dictate the direction as we go forward in terms of future rate cuts. If they're not needed and they see inflationary, they're not going to cut rates, which is a positive if they don't cut rates again, because that means our economy is back in growth mode.
Yeah,
and earnings are in growth mode.
I think we'll go right back to that point where we get a longer glide path. It's really, you know.
And you mean, John, the longer glide path, meaning we're not going to have a recession.
For the cycle, correct.
The cycle will continue.
The
economic expansion will continue.
The cycle will continue. We'll get a longer glide path before expansion rolls over. But, you know, it's sort of like that little clock that's ticking. You know, the faster we get this trade deal, the more likely I think it is that we kind of roll into a longer expansion. The longer we go without a trade deal, the higher the probabilities get of a recession, you know, prior to 2021. So, you know, I think the markets continue to have confidence in the administration that they're going to get this deal done, and that's why asset prices, although they haven't risen, they certainly haven't fallen a great deal either.
In terms of you know, price earnings ratio, Paul, and you know, dividend yield, and you know, the U.S. versus you know, foreign markets. Why don't we talk about that?
Yeah, I think this chart tends to be a little bit busy, but if we look at, you know, current PE, forward PE on the S&P 500, it is trading a little frothy relative to the 20-year average of about you know, 15.6.
It also has to be noted, 20 years ago, interest rates were 7-8%, and on a relative basis.
Absolutely. I mean, if we were to actually cyclically adjust that, but we won't get into those particulars. Just looking at valuations broadly, S&P 500 versus the rest of the international realm, you know, it looks a little bit expensive, but it's expensive for a reason. A lot of that has to do with the accommodation, or the over-accommodation, I would say, of our central banks, you know, with monetary policy.
Throughout the cycle.
Throughout the cycle, right. It hasn't even just been, and they're just given that capability.
We were cutting interest rates early in the cycle while Europe was implementing austerity programs. Our economy got jump-started first. We kind of took the pole position. And I think the reason why you see the S&P 500 trading at such a premium valuation to the rest of the world is justified by premium growth. So the United States, while it doesn't, you know, today we're certainly in a growth slowdown, but over the course of this 10-year cycle, the United States level of growth has been much higher globally than the rest of the world, and it's justified our what I would say our overweighting of U.S. markets versus international markets in client portfolios.
Yeah, and that's been many, many, many years that we've been overweighted, the U.S. versus international. You know, one thing here, and again, the esteemed Jeremy Siegel discussed, you know, if we get a trade deal, you'll see you know, nothing is ever guaranteed in life. There's only a couple of guarantees. Death and taxes. That's it. And but the expectation is that international will take off again just because of the earnings, and also the earnings. When you look at the earnings, they're expected to increase of U.S. companies because of the exposure to foreign markets, and the strengthening of those currencies will help U.S. corporate earnings. So again, I keep saying this, but a quarter after the trade deal is signed, a lot of these numbers may have significant adjustments that we're reviewing today. You know, in terms of interest rates, if you have any family member who refinanced probably or purchased a home the end of the year, they may want to consider looking at refinancing options now. Just a little five-star tip there, because rates now for a 30-year mortgage, you know, I'm hearing 3.5% is very, very common, and you know, we had somebody for a 15-year mortgage that got below 3. So again, that's just something to consider. Because some people got caught up in the cycle of raising interest rates. But one important piece here this does not read left to right, meaning the current numbers are on the left side. As I think John alluded to, the end of the year, John, the expectations were that we're going to have 2-3 increases this year by the Fed.
Yeah, I mean, I think this trade war threw expectations for a loop. We went from a Fed that was hell-bent on raising rates into a weakening economy through the end of 2018, which caused the markets to fall precipitously to an about face to neutral to becoming accommodative. And I think some of that reluctance to become accommodative caused the 10-year or the aggregate index to fall more precipitously, which is why rates are much lower today than they were last year.
Yeah, and we tell people in the state we're in, don't gamble on, if you're going to gamble, don't gamble on long-term bonds just because you see, nice increases this year, because if this trade deal is signed and our economy starts expanding, right, Paul, we possibly can see increases of rates even though the Fed's not moving.
You very well could. So one of the policy benchmarks that the Federal Reserve uses is core PCE, which strips out a lot of necessary inflation components. It's been running about 1.6%, below their 2% target, which part of that's justified. The other reason why we've seen rates by and large go lower is due to partially a contagion effect, where you had most of the developed market world, namely in Europe and Japan, have bond purchases, lower rates into the negative level. I mean, so if you look at global bonds minus the U.S., this is what the yield is, barely 0.75%. The U.S., on the other hand, is the only area in the world where you can actually get some meaningful yield to this day at 2.26%. It's a little bit higher than that, of course, now because yields did go up within the last 15, 16 days. But I think it's a testament to the fact that our asset allocation, which excludes international fixed income, is really good in terms of positioning, because you're not getting paid. I mean, why would we ever buy a Japanese or a German 10-year bond that has a negative yield and say losing profit?
You'd have to pay for the bond. You would lose money annually on the bond.
Or to further that point, why would a German?
Correct.
So international or global demand for U.S. Treasuries is strong because U.S. Treasury rates are so much better than the rest of the globe. So, foreign demand, I think, also has had a strong impact on U.S. rates.
Right.
Yeah, and a positive from that, remember the government has a significant amount of debt, and these low rates allows them to finance the debt at a very low rate, which is helpful for our debt servicing cost.
Right. But I just wanted to end with that one of the biggest risks to this, current interest rate environment is that if we do get an acceleration and other inflationary indicators, namely urban CPI, are showing numbers, closer to 3%. So the fixed income market, due to, trade concerns, due to foreign buyers coming in and bidding up prices, that could be reversed and I do believe that inflation is being understated by current fixed income rates.
Yep.
So that is a big risk.
Yeah, and that's been the case since they changed how they calculate inflation. And people have asked over the years, why would the government change? Because if there's a lower inflation rate by their calculations, there's lower increases on Social Security and other inflationary pieces of expenses. So, Brexit. Let's talk about Brexit for a second, Paul. A lot of people, even though England from an economic standpoint is not significant compared to the rest of the world, it still impacts everybody. Why don't you just talk about what's shaping up now?
Right. So, there's a December 31st deadline, fastly approaching, for the UK to essentially leave the EU with a deal from Brussels or without a deal. And I think all along, this has been a tribulation going back to 2016. It's really the uncertainty surrounding it, right? We're capable of at least loosely quantifying the impact to the UK at this point, what the potential impact would be to the EU. I think the broader theme is, does this portend to other EU members leaving? And that's where the uncertainty is really amplified. Much like in 2016 when Greece attempted to leave, and the amount of contagion effect that created, and a lot of volatility that ensued. This go around, I think the markets are realizing, okay, the UK has their own sovereign currency. They're not locked into the euro like all of the other countries are, Italy, Portugal, etc. So there's less of that risk. Relative to their economy, we're not talking about a huge difference in growth potential. So this chart is just looking at what their GDP potential would be going out to 2030 from today if they were to remain in the EU, get no deal, or get a Brussels deal. And as you can see, there's not that big of an impact.
Yeah, and in terms of what you can do in terms of what we do, recently had a client that is going to use a lot of cash, and we put the money in cash because it should be in cash. It's going to be a few $100,000 is going to be used in the next quarter to purchase a home. So we move the money in cash. So anything short-term should be in cash. And look at your long-term strategy from a standpoint of making sure you have a properly diversified portfolio. If you at some point recently, if you bet on small cap had a 20% correction. Don't gamble with your retirement and your investments. Have a side account that you gamble with. But the majority of your wealth, make sure that you have a properly diversified strategy that matches your goals and objectives. We've never seen, even through the financial crisis, if people manage their assets that way, they don't have concerns. And again, always make sure you have enough liquidity for your cash needs and emergency reserves. And, risk management, again, we've taken steps in the portfolios in May. John, we reduced our exposure to certain asset classes. It was just so happened, you're never going to time everything perfectly, but we actually timed it almost perfectly.
Right. I mean, we took advantage of the first quarter of the year, the strong push that we had, or recovery that we had from the drop that we had in asset prices in the fourth quarter of 2018. So we were able to take some profits. We were able to move some capital to more large cap U.S.
From small cap.
From small cap. And we also added a new factor-based exposure. Maybe Paul wants to explain what that might be.
Yeah, it's essentially we added in, John, the minimum volatility component into the portfolio, which just helps reduce downside risk within the equity portfolio.
All right, gentlemen. Thank you again for joining us for this webcast, and we look forward to continuing our series of these calls with you in the future. And if you missed any part of this webcast, a replay will be available on our webcast shortly. We really do appreciate your feedback, so please feel free to send us an email with your comments to pwm@prestigewmg.com.
One thing before we close it out, there was one question sent in. There's a couple of questions sent in, but really one that we can answer on this call today. And Paul, why don't you address that question?
Yeah, there was an individual that sent in a series. Some are security specific, so for the sake of compliance, we really can't provide individual stock recommendations over a call line like this. But one in particular that we can answer is question being, which sectors will be the hardest hit during the next stock downturn? Simple answer to that is really the most economically sensitive sectors. So if you look at all 11 sectors of the S&P 500, front and center is going to be basic materials, industrials, financials, consumer discretionary. Some areas of tech and biotech will be, hit hardest, but generally those, growth stories do tend to at least help buoy some of the downside risk. The defensive sectors being, consumer defensive, utilities, healthcare, as being, the sectors that would actually be more resilient in that environment.
I just want to point out there's a lot of risk to that, because if you're wrong, you could be very wrong.
Well,
And those sectors that Paul mentioned as being defensive may have returns that are very unlike market returns in that type of situation. So again, make sure you have the right portfolio for your situation, and don't place bets. And again, we want to thank everybody for the time.
Yes, thank you again. And if you have any questions and you'd like to email us at pwm@prestigewmg.com. Thank you again, everyone. Have a great day.